Interest rates are high. The media is yelling, crash. Every economic downturn tells the same story. Most people pull back. They wait. They listen to fear. Yet a small group, the ones who build real wealth, they move forward. They see opportunity where others see risk. They know that when the crowd is panicking, it's when fortunes are built. But behind the noise, the smart money is making bold moves. Not because they're reckless, because they're prepared. In this video, I'll show you how today's chaos could become the foundation of your wealth story. If you're ready to think differently, act boldly, and stop following the crowd, welcome to the passive path. Let's begin. Section 1. The education gap that keeps you broke? Let's be real. Most people aren't broke because they're lazy. They're broke because they're uneducated financially. Your school never taught you how money works. Neither did your job. We're told to work hard, save, and retire on a 401. Look how that's turning out. Here's the truth. If money isn't in your head, it won't stay in your hands. It's about understanding how money moves, and that starts here between your ears. Think about this. People spend hours hunting for sales on shoes. But when real estate is on sale, they run away. Why? Because they don't understand it. Lack of financial education creates fear. Fear keeps you on the sidelines. While you're waiting, the smart money moves in. Here's a simple example. Her husband had no idea what she was doing. No plan, no capital, no education. This is how people lose money. Not from bad investments, but from guessing. Want to avoid being that person? Then stop asking, what should I do? Start asking, what should I learn? Here's your action plan. Read books from people who've done it. Watch content like this. Join real estate meetups. Ask smarter questions. Build relationships with people doing real deals. If you're broke today, the first fix is your brain, not your bank account. Coming up, why real estate beats stocks, gold, and crypto. And why the wealthy never stop buying it. Section 2. WHY real estate is the foundation of wealth. Most people chase the hottest investment trend. One year it's crypto, next year it's AI stocks. But the wealthy, they build their wealth on real estate, not because it's flashy, but because it works. Real estate creates cash flow. It builds equity over time, comes with massive tax benefits, and you can use debt to grow faster. Try doing that with stocks. You buy a stock and it crashes, you're stuck. But with real estate, if you've bought right, the property still produces income. It's not about flipping houses, it's about owning assets that pay you every month. Let's break this down with a simple example. You invest $100,000 in real estate, you finance 70% with the bank. The property brings in rent. After expenses, you're cash flowing. You're paying down the loan. The property appreciates. Your tenant is buying the asset for you. Compare that to putting the same money in stocks. There's no leverage, no tax breaks, no control. Real estate lets you control the asset, even when the bank puts up most of the money. It's leverage. And it's how the rich multiply their returns. Even better, real estate is tangible. You can see it, touch it, improve it. Try renovating a stock. You can't. And that's why smart investors love dirt. In today's environment, this matters more than ever. Real estate prices in many areas are falling. Insurance is getting tougher. Interest rates are up. But this isn't a reason to panic. It's a reason to get smarter. It's a time to find deals others are too afraid to touch. When others run, the rich get to work. Because wealth is built in downturns, not during booms. And while others are waiting for the perfect time, the wealthy are creating it. You can't time the market, but you can time your education. And right now is the time to learn, the time to build, it's the time to prepare. Because once the cycle turns, you'll either be ready or too late. This is why the passive path exists, to help you think like an investor, act like an owner. Stop playing the short game. Real estate is not for everyone. But for those who study, commit, and stay patient, it's the ultimate vehicle. The stock market goes up and down in minutes. Real estate gives you time to think. to act with strategy, to make moves, not just guesses. And that's exactly what the rich are doing right now. They're not hoping, they're not dreaming, they're buying, and they're doing it with a plan. The foundation of wealth is built under pressure. It's built when others retreat. It's built when smart people buy smart assets. This is that moment. You can watch it happen, or you can become one of the people it happens for. Real estate isn't just property. It's the foundation of freedom. The next part will show you exactly why this moment, right now, could be your best chance in decades to start. The opportunity is here. What you do with it is up to you. Section 3. The current real estate market explained. The market today is not the same as it was 5 years ago. Interest rates have jumped. Insurance costs have exploded. Homeowners associations are raising fees. Natural disasters are hitting harder. Political shifts are creating uncertainty. But with all this chaos comes one thing: opportunity. Prices in places like Florida and California are dropping. Insurance companies are pulling out of high-risk zones. Some properties are sitting unsold. And for most people, this looks like a warning. For smart investors, it looks like a sale. This is what happens during every market cycle. Emotions drive the headlines, but data drives decisions. In the last 2 years, the bond market started cracking, and that's not small. The bond market is bigger than the stock market. China is dumping US bonds. Inflation has weakened the dollar. And rising debt levels are becoming harder to ignore. But while Wall Street watches the stock tickers, investors are watching real estate. So while markets crash, properties still stand. People still need places to live. Businesses still need space. Land doesn't vanish. And buildings don't disappear when interest rates rise. They just get repriced. When sellers get scared, prices fall. And that's when educated buyers step in. If you're waiting for perfect conditions, you'll wait forever. Real estate isn't about perfection, it's about positioning. When you understand the economic shifts, you can make bold moves with clarity. Right now, the Federal Reserve is fighting inflation. It means rates may stay high longer than expected. That creates short-term pain. But it also reduces competition. The tourists leave, the investors remain. This is the cleanup phase of the cycle, and cleanups are where fortunes are made. Buyers who understand how to structure deals can find gems. Sellers are motivated, distressed assets are appearing. Creative financing becomes possible. This is the time to think like a buyer, not a spectator. The passive path is about using these cycles to your advantage. Not avoiding risk, but understanding it. Not timing the market, but buying based on value. The smart money isn't guessing where prices go next. They're looking at fundamentals, location, cash flow, replacement costs, zoning. They're asking questions like, can this asset produce income today? Can I add value to it? Can I hold it through rough patches? Can I buy it cheaper than it's worth? These are the real questions that matter, not what the news says, not what the crowd thinks. When you stop following hype, you start seeing truth. And the truth is, this market right now is full of potential, but only for those who understand what they're doing. Next, we'll look at how the wealthy prepare when others panic, and how you can follow their moves, not their words. Section 4. How the wealthy prepare, not panic. The difference between the rich and everyone else isn't luck. It's how they respond to uncertainty. When markets crash, most people freeze. The rich take action. They don't react emotionally. They act strategically. They expect volatility. They prepare for it in advance. They hold assets that produce income. They keep reserves. They study the trends. They make decisions based on facts, not fear. We'll never see a wealthy investor say, I didn't see it coming, because they're always watching. When insurance rates rise, they adjust their underwriting. When interest rates spike, they look for seller financing. When home values fall, they negotiate harder. The goal isn't to avoid problems, it's to prepare for them. And preparation builds confidence. Confidence leads to action, and action is how wealth is built. Here's a simple truth. You can't predict the future, but you can prepare for it. The passive path is about building your strategy before you need it. So when others panic, you're calm. When others sell, you're buying. When others are unsure, you're already moving. Look at the people who have built real wealth. They didn't wait for permission. They didn't copy the masses. They studied. They asked better questions. They surrounded themselves with smart friends, and they took responsibility for their outcomes. This is the time to ask yourself, are you guessing, or are you planning? Are you hoping? Or are you preparing? Most people rely on headlines and tips. The wealthy rely on education and network. They go to events. They build relationships. They ask for feedback, challenge their assumptions, and they make decisions from a position of strength. They're not looking for the next hype trend. They're focused on real value, real assets, real strategy. You don't need to be rich to think like the rich. You need discipline, curiosity, and the willingness to learn. Because success isn't about timing the market, it's about timing yourself. You're either waiting or you're working. You're either reacting or you're planning. Planning is what turns panic into opportunity. Up next, we break down how the rich use debt to grow wealth, and how you can use the same tool without falling into traps. Section 5. The power of debt. Most people fear debt. The rich use it to build wealth. Debt isn't the problem. Ignorance is. When you understand how to use debt, it becomes a tool. When you don't, it becomes a trap. Good debt puts money in your pocket. Bad debt takes money out. Credit card debt is bad. High-interest loans to buy liabilities are bad, but using debt to buy income-producing assets is smart. Let's break it down. You find a property worth $500,000, put in $100,000. The bank lends you $400,000. Rent covers your mortgage, taxes, insurance, and still leaves profit. You're making money every month. The asset appreciates over time. Your tenant pays down the debt. You're building equity without using your own labor. That's the power of leverage. It's how the wealthy multiply their returns. Now imagine doing this at scale. 10 properties, 100 doors, all producing income. All using borrowed money to grow your net worth. That's the game the wealthy play. They don't use their own money. They use knowledge and relationships to borrow smart. But there's a catch. If you don't know what you're doing, leverage cuts both ways. Markets shift. Rents drop. Interest rates rise. Vacancy increases. And if you're not prepared, debt becomes dangerous. That's why education matters. You need to understand the deal, the numbers, the risk, and your exit plan. Don't borrow because you can. Borrow because the deal makes sense. The rich don't guess. They stress test every investment. Can the property survive a market correction? Can it cash flow at higher interest rates? Is there room to raise rents or reduce expenses? These are the questions that protect your downside. Debt is neutral. It's a multiplier. It makes good deals better. It makes bad deals worse. If you want to use debt, earn the right to use it. Study, partner with experts. Start small. And only scale when you've proven your model. Real estate offers one of the few legal ways to use debt for growth. Take advantage of it, but take it seriously. Used right, debt creates financial freedom. Used wrong, it creates financial pain. The passive path is about control. Control of your money, control of your growth, control of your risk. Next, we'll compare real estate to other major investment options. And why, despite the noise, it remains the most powerful vehicle for wealth. Section 6. Real estate vs. Other investments. You have options: stocks, bonds, crypto, cash. But real estate stands apart. Let's look at stocks. Stocks are liquid. You can buy and sell instantly. But that also means panic sells happen fast. You're exposed to market swings. You have no control over the business behind the stock. No influence on management. No ability to fix or improve anything. Your income depends on dividends, if any. Now take bonds. Bonds are considered safe. But today they're under pressure. Interest rates are rising. Governments are carrying massive debt. China is dumping U.S. bonds. And when bond prices fall, your portfolio suffers. Crypto. It's innovative, but it's volatile. Prices can swing 30% in a week. There's no cash flow, no collateral, and regulation is still catching up. What about cash? Holding cash in a high inflation environment means losing purchasing power every day. Now look at real estate. It produces income. It gives you leverage. It offers tax advantages. It's tangible, and you can improve it. You can renovate, reposition, raise rents, reduce expenses, and increase value. Try doing that with your stock portfolio. Real estate also benefits from inflation. When prices go up, so do rents. Your income grows while your debt stays fixed. That's built-in protection. And when markets go down, people still need homes. They'll still rent. And if you've bought right, your cash flow continues. Real estate has one more advantage. It forces discipline. You can't panic sell. You have to think, to plan, to manage. It creates stronger habits and better long-term outcomes. Most importantly, real estate gives you options. You can hold, refinance, sell, borrow against equity, or pass it to the next generation. It's not perfect, but it's powerful. It's not easy, but it's proven. The passive path focuses on strategies that give control, stability, and growth. Real estate checks all those boxes. Up next, we'll explore the hidden risks you must plan for, and how insurance, environment, and preparation make or break your investment. Section 7. Risk, reward, and the role of insurance. Every investment comes with risk. Real estate is no different. The key is managing the risk before it manages you. Start with location. Some areas are prone to natural disasters, floods, fires, hurricanes. These risks affect insurance rates and property values. If you're buying in a flood zone, you'll need flood insurance. That insurance is more expensive than ever, and your lender will require it. Some places, insurance companies are pulling out, not because of your property, but because of rising regional risk. Even if you've never filed a claim, your policy could be dropped. This is the new reality, and it requires new thinking. Risk is part of the business. Your job is to prepare for it, not avoid it. Interest rates are another factor. They've gone up fast. This affects your mortgage payments. It affects buyer demand. And it affects your ability to refinance. So your deal needs to work even if rates go higher. Run the numbers with margin. Don't stretch your budget. Build in buffers. Next is maintenance and infrastructure. Older buildings can have hidden costs, roof repairs, plumbing issues, code upgrades. Always do proper inspections and have reserves set aside. One overlooked risk is homeowners associations. In some areas, HOA fees are rising fast. They can kill your cash flow if you're not careful. Understand the rules before you buy. Ask for financials. Review upcoming repairs or assessments. Then there's tenant risk, vacancies, late payments, property damage. These are all part of the game. You reduce these risks with proper screening, good property management, and by owning in strong rental markets. One real example is in Puerto Rico. After Hurricane Maria, entire developments were destroyed. But the smart developers didn't walk away. They rebuilt. They upgraded everything to withstand Category 5 hurricanes. They used the disaster as a chance to build smarter. That's what good investors do. They prepare for the worst and build for the long term. Insurance is part of that, but it's not the only tool. Sometimes you increase your deductible to lower your premium. Sometimes you self-insure smaller items and cover only the big disasters. It's about balance, protection without killing profitability. Real estate rewards the prepared, those who do the homework, those who plan for what others ignore. If you only focus on returns, you'll miss the real picture. The best investors ask, what if? What if the roof leaks? What if rent drops? What if insurance gets canceled? And then they build their answers into the deal. That's risk management. And it's a skill you develop over time. Up next, we'll talk about the role of relationships. Why smart friends are your greatest asset, and how to build a network that makes you money long after the deal closes. Section 8. The power of community and mentorship. Wealth isn't built alone. It's built through connection. The people you learn from, people you partner with, people who challenge your thinking. Smart investors surround themselves with smart friends. Not people who agree with everything, but people who ask hard questions, push back, and bring new perspectives. One conversation can change your strategy. One connection can lead to your best deal. One mentor can save you years of mistakes. The wealthy understand this. That's why they show up at events, at summits, at roundtables. They spend time with others who are serious. They invest in relationships as much as they invest in assets. If you want to level up, change your circle. Find people who are doing what you want to do. Ask questions. Listen more than you talk, and bring value to the table. Don't chase celebrities. Find people with quiet success. Operators, doers, builders, the ones who are too busy working to brag online. These are the people who know how things really work. If you respect their time, they'll often open doors. Join masterminds. Attend workshops. Go on investment-focused trips. Not for the vacation, but for the proximity. You don't learn everything from books. You learn from the conversations in between. At dinner, on a walk, over coffee. That's where ideas are exchanged, deals are born, and confidence is built. When you hear how others solve problems, you get sharper. When you share your ideas and get feedback, you improve. Iron sharpens iron, and nothing replaces being in the room. You can watch from a distance, or you can sit at the table. The passive path is about action, and action includes building your network. Real estate is a team sport. You need brokers, lenders, contractors, managers, attorneys, and mentors. If you try to do it all alone, you'll burn out. The best investors leverage knowledge and relationships. They build teams, and they grow together. Don't just collect contacts, build trust. Give value. Be consistent. And watch your network become your greatest asset. Next, we'll talk about one of the biggest shifts in money. What happens when the baby boomers retire, and how that changes everything for investors. Section 9, the boomers are exiting. What that means for you, a major shift is happening in the global economy. The baby boomer generation is retiring, and they control a massive share of the world's wealth. As they exit the workforce and start drawing down their savings, money is leaving the markets. Pension funds are tightening. 401 withdrawals are increasing, and investment strategies are changing. Boomers were long-term investors. They bought and held for decades. Now they're selling. They're de-risking. They want income and stability, not growth. This puts pressure on stocks and bonds. It creates volatility. It shifts demand away from higher risk assets. But for a new generation of investors, it opens the door. Properties that were once tightly held are now for sale. Portfolios are being liquidated. Capital is being reallocated. This is a rare window. A massive transfer of assets is underway. Real estate investors who understand this can move fast. They can pick up assets from aging owners who want out. They can create solutions for heirs who don't want to manage property. They can reposition old properties for new uses. This shift isn't just about money, it's about mindset. The strategies that worked in the past won't work the same way in the future. You need to adapt. Think forward. And plan for what's next. Technology is changing how people live and work. AI is changing how businesses operate. Remote work is changing office demand. And new generations are changing how housing is used. This creates disruption. And disruption creates opportunity. but only for those who are paying attention. If you're stuck thinking like it's 1995, you'll miss what's coming in 2025. This is your time to study the trends, to see what others ignore, to ask new questions. Where will people want to live next? How will families use space differently? What kinds of properties will businesses need? When you answer these, you position yourself ahead of the curve. Wealth isn't about reacting. It's about anticipating. This is why strategy matters. Why data matters. Why education matters. And why now is not the time to sit still. The passive path is built for moments like this. When the old systems change, the new opportunities are just beginning. Next, we'll give you the tools to move from learning to doing. Clear action plan you can follow right now, Section 10. What to do now? Your action plan, knowledge without action, is wasted. If you've listened this far, you already think differently. Now it's time to move. Start with education. Read one book on real estate this week. Listen to one podcast episode every day. Watch real investors talk about real deals. The goal is to understand how money really moves. Next, join a local meet. Even if you're new, even if you don't know anyone, show up, ask questions, take notes. Your network starts there. Then look at your own finances. Know your credit score. Track your expenses. Build your reserves. You can't invest without knowing your numbers. Now find your first deal. It doesn't need to be big. It doesn't need to be perfect. It just needs to be real. A duplex, single-family home, a small rental. Run the numbers, estimate rent, calculate expenses, figure out your cash flow. If it doesn't make sense, move on. If it does, explore it. Talk to lenders, talk to agents, talk to property managers. Ask them what they see. You'll learn faster in the field than in theory. If you can't buy yet, partner, find someone with experience. Bring value, bring hustle, bring capital. Learn while you earn. Use the infinite return strategy. That means investing without your own money. Bring in other people's capital. Use seller financing. Use creative deal structures. The rich do this every day. You can too. Just be smart, be honest, and stay focused. Document everything. Track your results. Celebrate your progress, and stay consistent. Success in real estate isn't flashy. It's steady, it's patient, and it's intentional. This is how you build wealth on the passive path, step by step, deal by deal, learning every day, growing every year. If you got value from this, like the video, subscribe to the Passive Path, and leave a comment sharing your biggest insight. Yeah, this is your time. This is your opportunity, and it starts with action. You've just learned why the rich are buying real estate while everyone else panics. You've seen the mindset, the strategies, and the steps to take action. Now it's your turn. If this video helped you think differently, like it. If you want more content like this, subscribe to the Passive Path. Drop a comment below and share your thoughts. And if you know someone who needs to hear this, share this video with them today. Your journey to financial freedom is just getting started. Stay curious, keep learning, and take action. Good luck on your path. Feel free to check out the other videos on the channel to keep building your momentum. I'll see you in the next video.